Good evening. Thank you for being here. Imitation is the sincerest form of flattery, or at least that is what Oscar Wilde said. We often tend to imitate people who we believe are successful, but is it also the case when it comes to investing? Do we buy stocks based on what we read in the news, or do we buy stocks based on what we see others are doing? Well, we have real-life evidence to actually believe that we do copy each other's strategies. For instance, there's an app you can download right now on your iPhone that allows you to track the investments of publicly known figures, whether it's a successful investor like Warren Buffett or maybe even an elected official. A possible explanation for this is that we could think that others are good at making money in the stock market because they have access to a skill set or information that we don't have. My research asks whether institutional investors imitate each other. Institutional investors are these very large money managing companies that handle at least $100 million in assets each and up to $10 trillion. This includes money from mutual funds, university endowments, and even your own pension funds. Their holdings represent almost 80% of the US equity market. And the short answer to my question is yes, institutional investors do influence each other's behavior. To find out who is influencing whom, I built a statistical model based on past choices of investors. And by choices, I mean, what stocks did they buy, when did they buy them, and how much did they invest? I tested this model by using the largest data set available that includes all publicly listed companies in the United States across 12,000 stocks and 80,000 institutional investors. So the extremely high number of data points makes this estimation very difficult for individual investors. So what I do is I classify these investors into two previously well-studied categories. First, passive investors, who are those who follow an index like the S&P 500. Some examples could be BlackRock or Vanguard. And two, active investors who try to beat or outperform the market based by looking at individual stocks. And there's this notion that the active investors are more influential than the passive ones simply because they lead the market. However, my results show two important conclusions. First, investors make choices based on what others are doing and not necessarily only financial indicators. And second, that passive investors, regardless of their portfolio size, are actually more influential than active ones, going against this popular belief that actually prevails in markets. It turns out that the fluctuations in the stock market can be representative of changes in the real economy, but also of herd behavior. Or, said in other words, whether it's flattery or imitation, imitation is the name of the game. Thank you.